Okay, so what if I told you that with just like one single investment, you could basically own a tiny slice of every single company listed on the U.S. stock market?
Uh-huh.
I mean, not just the big names, the Apples, the Amazons, but like thousands of other businesses,
Well,
right? Companies you've probably never even heard of across every industry, every sector.
from the giants down to the really small ones, yeah.
Exactly. It sounds, I don't know, almost too powerful, maybe too simple. But that's really the core idea behind these total stock market index funds, specifically the ETS, like VTI and ITOT.
It really is.
So today, that's what we're diving into. We're going to unpack what these funds actually are, why they're so popular, look at the benefits, compare the two big players, VPI and ITOT.
And how they stack up, yeah?
And then get into the practical side, like how you actually buy them, which honestly, the sources had some interesting debates about that.
Yeah, the market order thing.
Right. And importantly, we need to tackle the taxes because that can get complicated, especially if you're not holding them in, say, an IRA.
Definitely. A crucial piece, especially for taxable accounts.
So think of this as like your quick way to get up to speed on a really powerful investment strategy, one that honestly forms the bedrock for a lot of long-term investors.
It's a strategy that really, turned traditional investing on its head. The whole concept that maybe you can't consistently beat the market.
Right.
And that for most people, the smartest move is just to own the market itself. That was, well, it was pretty revolutionary when it first came out.
People were skeptical.
Oh, hugely skeptical, even laughed at it, But look where we are now. Index funds, including these total market ones, they manage trillions. One source said over $16 trillion in U.S. index funds by the end of 2024.
Wow. That's incredible.
Yeah, that kind of growth, it tells you there's something really compelling going on there, some real value.
Okay, so let's start right there. For anyone who's maybe new to this or just needs a quick reminder, what is a total stock market index fund? Maybe we should start with just index fund first.
Good idea. So think of a market index, maybe like the S&P 500. It's essentially a list, right? A curated group of stocks representing a part of the market.
Like a benchmark.
Exactly, a benchmark. An index fund, then, is just an investment product. Could be a mutual fund, could be an ETF, and its only job is to copy the performance of that specific index.
So no active managers trying to pick winners.
Nope. That's the key difference. Active managers are constantly researching, buying, selling, trying to outperform. Index funds, they're passive. They just buy whatever's in the index in the same amounts.
And they only change things when the index itself changes.
Precisely. The goal isn't to be better than the market segment. It's just to be that market segment, to match its return.
And the history there is pretty cool, right? John Bogle at Vanguard back in the 70s.
Oh, yeah. When he launched the first index fund for regular folks, they literally called it Bogle's Folly.
Folly. Like, it was a crazy idea.
People thought, why would you want average market returns? The whole game was about finding managers who could beat the average.
But Bogle saw something else.
He saw the costs, all the fees for those active managers, the trading costs. He realized it was a huge drag on returns over the long run.
So even if a manager did pick some winners,
the cost could easily eat up any outperformance, leaving the investor behind the simple index return. His passive, low-cost approach was radical then, but, well, history proved him right.
Okay, so that's the basic index fund. How does a total stock market index fund take that concept further? What makes it total?
Right. This gets back to that owning everything idea. A total stock market index fund tracks an index that's designed to cover the entire U.S. stock market, or, as close as possible.
Not just the biggest 500 company?
We're talking indexes that include basically all publicly traded U.S. stocks. Large caps, yeah, but also mid caps, small caps, even those tiny micro caps.
So thousands of companies.
Thousands. When you buy a share of VTI or ITOT, you're instantly getting exposure to this huge range of businesses across all sectors, all industries in the U.S. It's the broadest possible U.S. stock exposure you can get in one go.
And VTI tracks the CRSP U.S. Total Market Index, while ITOT tracks the S&P Total Market Index, both aiming for that comprehensive coverage.
That's the goal. Give you the return of the overall U.S. market tide, whatever it's doing, in a simple, low-cost way.
Which brings us straight to the why. Why have these become such a big deal? What are the main benefits?
Oh, the benefits are really significant. And the first one, probably the biggest one, is diversification.
Okay, don't put all your eggs in one basket. We hear that all the time. But break it down for us in this context. What does diversification do here, and what risk does it actually help with?
So diversification is just spreading your money out, okay?
Yeah.
Across different companies, different industries, different sizes of companies. The idea is if one part of your portfolio does poorly, hopefully another part does better and balances things out.
Smooths out the ride a bit.
Exactly. But it's crucial to understand what kind of risk it helps with. There's what we call systematic risk or market risk. Think big picture stuff.
Yeah.
Inflation, interest rates going up, a recession, geopolitical shocks.
Things that affect pretty much everyone.
Right. And diversification within the stock market won't save you from that. If the whole market drops 20%, your total market fund is going down roughly 20% too. You can't diversify away market risk.
Got it. So what can you diversify away?
That's unsystematic risk, sometimes called diversifiable risk or specific risk. This is the risk tied to one specific company or one specific industry.
Like a bad earnings report for one tech company, or new regulations hitting just the airline industry.
Perfect examples. Or a scandal at a single company. If you only own, say, 5 stocks and one of them gets hit with terrible news, your whole portfolio could take a massive hit. That's unsystematic risk biting you.
So the source mentioned comparing airline stocks to railway stocks, or even diversifying beyond transportation altogether into something like streaming. That's managing this specific risk.
Precisely. And this is where total market funds shine, because they hold thousands of stocks across the entire market.
No single company failure can really hurt you that much.
Exactly. If some small cap company goes bust, it's probably, 0.01% of the fund, maybe less. The impact on your overall investment is tiny, practically unnoticeable. You've effectively diversified away that specific company risk or specific industry risk.
So you still ride the overall market wave up or down, but you're protected from, picking the one stock that blows up.
That's a great way to put it. It simplifies risk management hugely. Now, the source did mention that counterargument, the Carnegie or Buffett idea.
Keep all your eggs in one basket, but watch that basket closely.
Right. The idea that intense focus on a few green investments could lead to much bigger returns than just owning the average.
If you pick the right basket and watch it like a hawk.
Yeah, and maybe for a full-time professional investor with tons of resources and expertise, maybe that works. But for most of us, the time, the skill, the sheer luck involved in consistently picking those winners and avoiding the losers, it's incredibly difficult.
So diversification is the more practical path for most people.
Absolutely, especially with something like a total market fund. It's the low-effort, high-probability way to get market returns while minimizing those company-specific blow-up risks. It's just really effective risk management for unsystematic risk.
And that difference, compounded over, say, 30 years.
Okay.
It's huge. The source had that example. $100,000 invested, 8% return. The difference between paying 1% versus just 0.10% in fees was over $220,000.
Over $220,000. That's money that stays in your pocket working for you instead of going to the fund company. Low cost is probably the single most reliable advantage you can give yourself as an investor.
And VTI and ITOT.
Both charge just 0.03%, 3 basis points. Is incredibly cheap. As the source said, comparing them on cost, it's a total wash. Negligible difference.
And not just the annual fee, right?
Yeah.
There's the cost of actually buying them. ETFs trade like stocks.
Right. And nowadays, most big brokers offer commission-free trading for ETFs. So buying shares of VTI or ITOT costs you nothing in commission.
Which the source contrasted with buying, say, 25 individual stocks. You'd pay a commission on each one, potentially.
Exactly. Adds up fast, especially if you're investing smaller amounts regularly. Buying one ETF share commission-free makes getting that broad diversification super cost-effective right from the start.
Okay, so massive diversification, super low cost. What's the third main advantage?
Simplicity and transparency, which for a lot of people is a really big deal.
How so?
Well, the strategy is dead simple. Track the market. You know exactly what you own because the fund just follows a published index. There's no black box, no wondering what the manager's thinking or doing.
It's transparent. The holdings are public.
Totally transparent. And simple because you don't need to spend your weekends researching stocks or trying to guess which way the market's headed. You just invest regularly, knowing you're getting that broad market exposure. Takes a lot of the stress and guesswork out of it.
Although the source did mention there are still managers involved, right? Making sure it tracks the index properly.
Oh, absolutely. It's not completely robotic. There's professional oversight to ensure the fund does its job accurately, minimizing tracking error. But their job isn't stock picking. It's precise replication.
Got it. Okay, that makes a strong case for the general concept. Now, let's zoom in on the two main players we keep mentioning, VTI from Vanguard and ITOT from iShares, which is BlackRock. The sources, especially that Reddit thread, noted that VTI seems to get more buzz, but ITOT looks almost identical on paper. So how do they compare?
That's a great question, and it's true. For like 99% of investors, VTI and ITOT are functionally twins. Their goal is exactly the same. Track the entire U.S. stock market very closely.
And the specs look pretty much identical in the key areas.
Yeah, let's run through them. Both aim for that total U.S. market exposure. Both are market cap weighted, meaning they're dominated by large cap stocks, like 87%, because large companies make up most of the market's value.
Expense ratios.
Identical, 0.03%, rock bottom.
Liquidity. Trading costs.
Both incredibly liquid. They trade millions of shares a day with super tight bid-ask spreads. So buying or selling is easy and cheap.
Risk.
Risk profiles are virtually indistinguishable. The sources mention metrics like beta being nearly identical, R squared close to 100%. Sector weights are basically the same. And, most importantly, their long-term performance track records are, and should continue to be, almost exactly the same.
Okay, so if they're that similar where it counts, where are the differences? Even the small ones.
The main technical difference is the specific benchmark index they track. VTI uses the CRSP US Total Market Index. ITOT uses the S&P Total Market Index.
And the CRSP index has a few more stocks.
Slightly more, yeah. The CRSP covers around 4,000 stocks, give or take, while the S&P one covers closer to 3,600.
Does that actually matter in practice? Does it change what you own?
Honestly, not really. The extra stocks in the CRSP index are overwhelmingly tiny microcap companies. Because the indexes are market cap weighted, these tiny stocks have almost zero impact on the fund's overall performance or behavior.
So the overlap is huge.
Yeah. Massive. The sources estimated something like 98% overlap in terms of the weight of the holdings. Owning VTI versus ITOT means you're holding virtually the same basket of U.S. stocks in practice.
What about size? VTI is much bigger, right? Assets under management?
Yeah, VTI is significantly larger. The source said maybe $276 billion versus $40 billion for ITOT. But does that matter for an individual investor? Almost certainly not.
Why not?
Both are absolutely enormous funds with fantastic liquidity. Maybe if you're a giant institution trading millions of dollars at once, VTI's slightly larger size could offer a tiny edge in liquidity. Or maybe its options market is a bit deeper, as someone on Reddit suggested. But for regular folks buying shares, ITOT is plenty big and plenty liquid. No issue there.
And there was that historical footnote about ITOT switching its index.
Right. Back around 2015 or 2016, it used to track a different S&P index before switching to the S&P Total Market Index. So if you look at performance charts going way back, you need to be aware of that switch. But since then, they've been tracking very comparable total market benchmarks.
And the Vanguard versus iShares BlackRock connection. Less important now.
Much less important than it used to be because commission-free trading is so widespread. Years ago, you might have chosen based on which one your broker offered commission-free, but now you can likely get both without commissions at most major brokers.
So, bottom line, choosing between them, it doesn't really matter for most people.
For the vast majority of investors focused on long-term returns, cost, and getting that broad market exposure, no, there's virtually no practical difference. Pick whichever one you like. Maybe the interface at your preferred broker is slightly easier for one, or maybe you just like Vanguard or BlackRock better. It often comes down to just simple preference or inertia.
That Reddit discussion highlighted one specific kind of clever reason to care about the difference. Tax loss harvesting.
Ah, yes. This is actually a really smart point for people investing in taxable accounts, not retirement accounts.
Explain that. The wash sale rule.
Right. The IRS has this rule, the wash sale rule, that says you can't claim a tax deduction for selling a security at a loss if you buy back the same security, or one that's substantially identical within 30 days before or after the sale.
So you can't just sell VTI for a loss on Monday and buy it back on Tuesday to get the tax break but keep the investment.
Exactly. But here's the key. Because VTI tracks the CRSP index and ITOT tracks the S&P index, even though those indexes are super similar in practice, the IRS generally considers them different enough that they are not substantially identical for wash sale purposes.
Ah, so you could sell VTI at a loss.
And immediately buy ITOT to maintain your total U.S. market exposure and still potentially claim the tax loss from selling VTI, or vice versa.
That's actually pretty useful, a way to capture tax losses without being out of the market.
It's a specific strategy, often used by people with larger taxable portfolios, but it's a valid reason why knowing they track different indexes matters for just buying and holding long term. interchange.
Yeah.
For tax loss harvesting, they offer a useful pairing.
Okay, that makes sense. Let's switch to part 4 then, the practical side of things. That Reddit thread really showed people wrestling with the how, funding the account, which order type to use, wanting automation. It seems easy in theory, but the execution can trip people up.
It really can. Those practical hurdles are real. But for these specific funds, VTI and ITOT, it's actually pretty straightforward once you know the steps.
So step 1, open a brokerage account.
Yep. Most big online brokers will let you do that easily, and most offer VTI and ITOT commission-free.
Step 2, fund it. Transfer money from your bank. The Redditor was frustrated by the delay there.
Right, waiting for funds to settle. But as others pointed out, many brokers now give you instant buying power, at least for ETFs, as soon as you initiate the transfer. People mentioned Fidelity, Vanguard, JP Morgan doing this.
So you don't necessarily have to wait days to buy.
Often, no. Check with your specific broker, but immediate buying power is common now. Step 3 is just placing the buy order using the ticker symbol VTI or ITOT.
Okay, but this brings us to that anxiety point. Market orders versus limit orders. The person on Reddit was taught only dummies use market orders. Why the fear, and is it justified for VTI ITOT?
The fear isn't totally unfounded in some situations. A market order just says, buy now at the best available price. A limit order says, buy only if the price hits my target price or lower.
And the risk with a market order is the bid-ask spread.
Exactly. The gap between the highest bid, what buyers offer, and the lowest ask, what sellers demand. For a stock that doesn't trade much and a liquid stock, that spread can be wide. Placing a market order might mean you buy at the ask, which could be noticeably higher than the bid. That's where you can get burned with a market order.
But VTI and ITOT aren't illiquid.
Far from it. They are among the most liquid ETFs in the world. Trading volume is massive. Because of that, their bid-ask spread is incredibly tight. We're talking pennies or fractions of a penny.
So as the Redditor said, it's basically a rounding error.
Pretty much, yeah. The tiny difference in price you might get between a market order and a perfectly placed limit order on VTI or ITOT is almost always negligible, maybe a cent per share.
So for these funds, using a market order is actually fine.
Based on the sources and their liquidity, absolutely. It's simple, it guarantees your order gets filled immediately, and you're invested. The risk of getting a bad price is minimal.
And trying to set a limit order way below the market, like 1% down.
Usually pointless for these funds, as the commenters noted. The chances of a sudden 1% dip just to hit your order aren't high on a normal day. You just risk sitting on the sidelines while the market potentially moves up without you.
Time in the market beats timing the market.
That's the key principle here. Don't let trying to save a fraction of a cent stop you from getting invested. For VTI and ITOT, market orders are generally the way to go for simplicity and immediate execution.
What about automating investments?
Yeah.
Like setting up automatic monthly purchases?
This is where ETFs have traditionally been a bit trickier than mutual funds. Old school mutual funds like VTSX at Vanguard, the mutual fund version of VTI, make automatic investing super easy. Set it and forget it.
But ETFs trade like stocks, so usually manual buys.
Historically, yes. You often had to log in each month and place the trade yourself. However, things are changing. Vanguard mentioned in one source that they're rolling out automatic ETF investing starting in January 2025.
Okay, so that gap is closing.
It seems to be. And even before that, some platforms were built for it. M1 Finance was mentioned on Reddit. They let you set target allocations, and they automatically invest your contributions into the right ETFs to maintain those targets. So solutions exist or are coming.
Good to know. And fractional shares.
Also a big help, some brokers like Robinhood and M1 mentioned in the thread let you buy fractions of ETF shares. So if VTI costs $250, you don't need $250 to start. You can invest $50 and buy 0.2 shares.
Lowers the barrier to entry.
Significantly. Makes it easy to invest any amount, big or small, regularly.
So practically speaking, buying VTI TOT is easy, market orders are fine, automation is getting better, and fractional shares help you start with any amount.
Exactly. Don't let the mechanics intimidate you. The focus should be on consistent investing.
All right, let's tackle the beast. Part 5, taxes. Especially in taxable accounts, this can get confusing fast, and the Schwab source really laid out some crucial details.
It's definitely an area where you need to pay attention. So the basic rule for investments in a regular taxable brokerage account is you owe tax on two main things. First, when you sell shares for a profit, that's a realized capital gain.
And second,
Second, on distributions, the fund pays to you, even if you don't sell any shares. Think dividends or capital gains the fund itself realized.
Okay, let's do the selling part first. If I sell VTI after holding it for, say, 6 months,
Profit is a short-term capital gain. Tax at your regular income tax rate could be high.
and if I hold it for over a year before selling,
Then it's a long-term capital gain, taxed at lower rates, 0%, 15%, or 20%, depending on your overall income. Much better, usually.
and for higher earners, there's that extra 3.8% tax.
Right, the net investment income tax, NIIT, kicks in above certain income levels on investment income, including capital gains and dividends.
Okay, that's when I sell. But you said I can owe tax even if I don't sell, because the fund distributes stuff.
Exactly. This catches people by surprise sometimes. Funds, both ETFs and mutual funds, have to pass through any net income or net capital gains they make internally to their shareholders, usually once a year for capital gains.
So the fund sells some stocks it holds, makes a profit, and I get a piece of that profit as a distribution, which I then owe tax on.
That's right. Even if you just bought the fund yesterday, or even if the fund's price went down overall that year, if the fund realized net gains internally, those get distributed and are taxable to you in the year you receive them. Doesn't matter if you reinvest them automatically.
Okay, how are those distributions taxed?
Depends what's being distributed. VTI and ITOT hold stocks, so they pay out dividends, usually quarterly. Those dividends might be qualified and taxed at the lower long-term capital gains rates, or non-qualified and taxed as ordinary income. Depends on holding periods and stuff.
And if it's a bond ETF,
It distributes interest, usually monthly, taxed as ordinary income.
and the capital gains distributions from the fund selling its own holdings.
Those are passed through to you as either short-term or long-term capital gains. But here's the twist. Whether it's short-term or long-term depends on how long the fund held the stock it sold, not how long you've held the ETF shares.
Huh. So if VTI sells a stock it held for 5 years at a gain, that comes to me as a long-term gain distribution, even if I only bought VTI last month.
You got it. And this is where index funds like VTI and ITOT generally have a big tax advantage over actively managed funds.
Because active funds trade more often. Lower turnover for index funds.
Exactly. Index funds mostly just buy and hold, only selling when the index changes. Active funds are constantly buying and selling, trying to time the market or pick winners. That generates way more internal capital gains.
Which then have to be distributed and taxed.
Right. So index funds tend to be much more tax efficient because they distribute far fewer capital gains year to year. Less unexpected tax bills for you in a taxable account.
Okay, so for plain vanilla equity ETFs like VTI, ITT, the tax story is pay tax when you sell at a profit, preferably long-term gains, and pay tax on dividends and the relatively infrequent capital gains distributions from the fund itself. That seems manageable.
It is, relatively speaking, but the Schwab source then went deep on other types of ETFs where the tax rules get really, really different and complex.
Okay, let's brace ourselves. What about things like commodity ETFs that use futures contracts?
Right. These are often structured differently, maybe as limited partnerships. That means instead of a simple 1099 tax form, you get a Schedule K1.
Which is more complicated and often arrives later, right?
It
Messing
will.
up tax filing.
Yep. Plus, the source mentioned a potential issue called UBTI, unrelated business taxable income, if you hold these partnership structures in an IRA. Something to look into, referencing IRS Pub 598.
And the tax calculation itself is weird, the 60-40 rule.
Yeah, this applies to many futures-based ETFs. Any gain or loss from the futures trading is treated as 60% long-term capital gain loss and 40% short-term capital gain loss, regardless of how long you held the ETF shares.
So if I hold it for 3 months and have a gain, 60% gets the lower long-term rate. That sounds good.
It can be for short holding periods, but if you hold it for 5 years, 40% of your gain is still taxed at the higher short-term ordinary income rate, which is worse than standard long-term gains treatment.
And mark-to-market.
Another fun futures rule, at year-end, the fund's open futures contracts are basically treated as if they were sold. Any unrealized gains or losses get marked to market, realized for tax purposes, and distributed under that 60-40 rule. So you can owe taxes even if you didn't sell anything and the fund price didn't go up much just because of these internal year-end calculations.
Wow. Okay, that's way more complicated.
Definitely requires more homework. Schwab did note some newer commodity funds use different structures to avoid K1s and 60-40, maybe using offshore subsidiaries so they get taxed more like regular funds, but you have to read the prospectus to know.
What about gold or silver ETFs, backed by actual physical metal?
If it's a grantor trust holding the physical bullion, the IRS treats your investment like owning a collectible.
Like art or stamps?
Sort of. Tax-wise, it means if you hold for over a year and sell at a gain, Your maximum long-term capital gains rate is 28%.
Higher than the usual 15% or 20% for stocks.
Right. Short-term gains are still ordinary income. And again, if the metals ETF uses futures, it falls under the 60/40 rules, not the collectibles rules. Prospectus is key.
Currency ETFs.
Super variable. Could be an open-end fund, standard tax, grantor trust, maybe ordinary income. Limited partnership, pay 1, 60/40. Depends entirely on the structure. Prospectus, prospectus, prospectus.
And those new spot Bitcoin ETFs.
If structured as grantor trusts holding actual Bitcoin, they're treated as investments in property. So standard capital gains rules apply. Long-term if held over a year, short-term if held a year or less.
Okay. And NTNs were mentioned too. Exchange-traded notes.
Briefly, they're debt instruments, so they have issuer credit risk. Tax on gains when you sell is usually similar to an equivalent ETF based on holding period, but they generally don't pay out dividends or interest along the way.
Man, that's a minefield of complexity for anything beyond basic stock bond ETFs. What's the single biggest takeaway from Schwab to simplify all this tax mess?
The absolute most critical point is that almost all of this complexity, the K1s, the 60/40 rule, collectibles tax, mark-to-market, really only matters if you are holding these investments in a taxable brokerage account.
So if I hold VTI or even one of those complicated commodity ETFs inside my traditional IRA or 401k?
Then generally none of that matters within the account. You pay no taxes year to year on dividends, interest, capital gains distributions, or gains from selling inside the retirement account. All the growth is tax deferred.
The complexity just vanishes inside the tax shelter.
Pretty much. You only pay taxes later, when you withdraw money from the account in retirement. And typically, those withdrawals are just taxed as ordinary income at whatever your rate is then, regardless of what generated the gains inside the account or how long you held things.
That simplifies things enormously.
It really does, which is why for many people, using tax-advantaged accounts first is so powerful. It avoids all this tracking and complex tax reporting year after year. If you are investing heavily in a taxable account, though, you absolutely need to understand the specific tax rules for the type of ETF you're buying, especially if it's not just plain stocks or bonds.
And talk to a tax pro.
Always the best advice for personalized situations. Don't rely just on a podcast.
Absolutely. Okay, wow. We have covered a ton of ground, from the big picture down to the weeds of the tax code. Let's try to wrap this deep dive up.
Sounds good. We started with that really appealing idea, own the whole U.S. market with one click. And we saw how total market ETFs like VTI and ITOT make that possible and pretty easy.
And the reasons why are clear, right? You get that incredible diversification, thousands of companies smoothing out the bumps from any single one failing. That's huge for reducing risk.
Definitely. Then there's the cost factor. Those rock-bottom expense ratios, like 0.03%, save you potentially hundreds of thousands in fees over decades compared to more expensive funds. That's real money staying in your portfolio.
Plus, the simplicity. You know what you own the market. No complex strategies to follow. Just track the index. Makes investing less stressful.
And we saw the practical side isn't too scary. Buying is straightforward. Market orders are usually fine for these liquid giants. Automation is getting easier. Fractional shares help everyone get started.
Then we navigated the tax maze. Standard equity ETFs like VTI and ITOT are manageable in taxable accounts. But step outside that into futures, metals, currencies, and it gets complicated fast with different rules like K1, 60/40, collectibles rates.
But crucially, putting those investments inside an IRA or 401k makes most of that tax complexity disappear until withdrawal. A huge simplification.
So key takeaways. Total market funds own the U.S. market. Diversification reduces specific risk. Low costs do more money for you. VTI and ITOT use basically twins, unless you're tax loss harvesting. And taxes know the rules for your ETF type, especially in taxable accounts, or use tax-advantaged accounts.
That sums it up well. It really is a cornerstone strategy for building long-term wealth through broad market exposure efficiently and effectively.
So as we close out, here's maybe one last thought for you, the listener, to chew on. We spent a lot of time talking about the power of diversification, owning everything, spreading your risk. Based on knowing that beating the market is tough, so maybe just being the market is the smarter play.
The humble approach, in a way.
Right. But we also touched on that other idea, the Carnegie or Buffett way. Concentrating your bets on a few things you understand deeply, watching them intensely, aiming for potentially much higher returns.
The high conviction, high potential reward, and high potential risk approach.
Exactly. So the question for you, as you think about your own investing journey, is how do those two ideas fit together for you? How do you balance the proven, simple, low-cost benefits of broad diversification like VTI and ITOT offer, with the allure, the effort, and the risk of trying to find those few big winners. This is a really fundamental question about your relationship with investing, something to think about.
It is. Understanding where you fall on that spectrum helps clarify your strategy and stick with it.
Well, that's our deep dive for today on total stock market index funds. Thanks so much for joining us.